Today we're diving deep into a unique exchange-traded fund called the KLIP ETF. Now, this isn't your typical China internet play. KLIP promises a twist: growth potential of the Chinese internet sector combined with steady income generation. Sounds too good to be true? We'll crack open the KLIP mystery, unpacking its fees, risks, and how it stacks up against other China ETFs. But before we jump in, is KLIP the key to unlocking Chinese internet riches, or is there a hidden catch? Stick around to find out, as we explore the KLIP ETF in the next 30 seconds. What is the underlying investment thesis for the KLIP ETF? The underlying investment thesis for the CraneShares China Internet Covered Call Strategy ETF, KLIP, revolves around two key aspects. 1. Exposure to the China internet sector. KLIP provides exposure to the Chinese internet sector, which has historically exhibited significant growth potential. China's internet and technology industries have been major drivers of the country's economic development. These industries boast a large and growing domestic user base, along with innovative companies. 2. Generating income through covered calls. KLIP employs a covered call or buy-right strategy. This strategy involves buying shares. KLIP invests in the holdings that track the CSI Overseas China Internet Index. This index reflects the performance of publicly traded Chinese internet companies. By extension, KLIP gains exposure to the potential growth of these companies. Selling call options. KLIP simultaneously sells call options on the underlying holdings, typically the KLIP ETF. These call options grant the buyer the right, but not the obligation, to purchase the holdings at a specific price, strike price, by a certain date, expiration date. The underlying thesis combines these aspects to achieve two goals. Capital appreciation. KLIP benefits from any price appreciation in the Chinese internet stocks it holds, similar to a traditional China internet ETF. Income generation. By selling call options, KLIP collects premiums upfront. These premiums represent additional income for investors, regardless of whether the stock price rises or falls within a certain range, as long as the price stays below the strike price of the call options. Essentially, KLIP aims to offer investors a combination of growth potential, through its exposure to the promising Chinese internet sector, income generation, through the premiums collected from selling call options. What market niche or opportunity is the KLIP ETF targeting? The KLIP ETF targets a specific market niche within the exchange-traded fund, ETF, landscape by catering to investors interested in the Chinese internet sector with the added benefit of income generation. Here's a breakdown of the niche it targets. Market niche: China internet sector with income. China's internet growth. The Chinese internet sector has been a key driver of the country's economic growth. It boasts a large and rapidly growing domestic user base, fostering a fertile ground for innovative companies. This sector has historically exhibited significant growth potential, attracting investors seeking exposure to this dynamic market. Traditional China Internet ETFs. Several ETFs already provide pure exposure to the Chinese internet sector. For instance, the KLIP ETF tracks an index of leading Chinese internet companies. These ETFs offer the potential for capital appreciation if the underlying companies perform well. The opportunity: income generation. KLIP differentiates itself by incorporating a covered call strategy on top of its China internet exposure. This strategy targets investors who desire growth potential. Similar to traditional China internet ETFs, KLIP offers the potential for growth if the holdings within the CSI Overseas China Internet Index appreciate in value. Income generation. Unlike traditional China internet ETFs, KLIP seeks to generate income through selling call options on the underlying holdings. These call options generate premiums that provide a return regardless of whether the stock price rises or falls within a certain range. KLIP targets investors who want to capitalize on China's internet growth. They believe the Chinese internet sector has promising prospects and want exposure to its potential. Generate regular income. They appreciate the additional income stream from the call option premiums, which can enhance their overall returns. Mitigate downside risk. To some extent, the covered call strategy can offer some downside protection compared to a pure internet ETF. If the stock price falls moderately, the income from the call options can help buffer the losses. How does the KLIP ETF's investment strategy align with current market trends? The KLIP ETF's investment strategy aligns with some current market trends, but also has aspects that might be less attractive in the current climate. Here's a breakdown of the alignment and potential misalignment. Alignment with current trends. 1. Focus on growth sectors. There's a general trend towards investing in sectors with high growth potential. The Chinese internet sector fits this bill, with a large user base and innovative companies. KLIP offers exposure to this growth potential. 2. Income generation. Rising interest rates and inflation are making income generation a more attractive feature for investors. KLIP's covered call strategy aims to provide regular income through call option premiums, appealing to investors seeking ways to hedge against inflation and generate additional returns. Potential misalignment with current trends. 1. Market volatility. The current market environment is experiencing higher volatility. While the covered call strategy can offer some downside protection, it also caps potential gains if the market experiences a significant upswing. This might be less appealing to investors seeking uncapped growth potential, especially if the Chinese internet sector outperforms expectations. 2. Uncertainty in China. Geopolitical tensions and regulatory concerns surrounding Chinese companies can create uncertainty for investors. KLIP's focus on the Chinese internet sector exposes investors to these risks. What is the expense ratio of the KLIP ETF compared to similar ETFs? The KLIP ETF has an expense ratio of 0.95%. This expense ratio can be compared to similar ETFs targeting the Chinese internet sector or employing covered call strategies. Here's a breakdown. KLIP ETF expense ratio, 0.95%. This expense ratio represents the annual fee charged by the ETF for its management and operational expenses. A higher expense ratio translates to a higher cost for investors, eating into their overall returns. Similar China Internet ETFs. Several ETFs offer pure exposure to the Chinese internet sector. Here are some examples and their expense ratios. KWEB, CraneShares CSI China Internet ETF 0.48%. CQQQ, Invesco China Technology ETF 0.70%. FXI, Franklin Templeton China Technology ETF 0.70%. Similar covered call ETFs. There might be fewer ETFs directly comparable to KLIP's specific combination of China Internet exposure and covered calls. However, some ETFs utilize covered call strategies in different sectors. These can provide a general reference point for expense ratios. XYLD, SPDR S&P 500 by Right ETF 0.63%. There are likely other covered call ETFs targeting different sectors, but finding a direct comparison might be difficult due to the unique combination of KLIP. Analysis. KLIP's expense ratio, 0.95%, is higher than most pure China Internet ETFs like KWEB, 0.48%, CQQQ, 0.7%, and FXI, 0.7%. This means investors in KLIP pay a higher annual fee compared to these alternatives. Compared to some covered call ETFs in different sectors, e.g., XYLD at 0.63%, KLIP's expense ratio is slightly higher. What is the underlying index or benchmark that the KLIP ETF tracks? The underlying index that the KLIP ETF tracks is the CSI Overseas China Internet Index. This index serves as the benchmark for KLIP's investment strategy and influences its holdings selection and overall performance. Here's a deeper dive into the CSI Overseas China Internet Index. CSI Overseas China Internet Index. This index is constructed and maintained by Sindex, CSI 300 index provider, a leading Chinese financial index provider. The index focuses on Chinese internet companies listed on stock exchanges outside of mainland China, primarily in Hong Kong and the United States. It includes companies operating in various segments of the Chinese internet sector, such as e-commerce, social media, online gaming, and internet portals. How the index influences KLIP. KLIP strives to replicate the performance of the CSI Overseas China Internet Index, meaning its holdings and weightings should closely mirror those of the index. The specific companies included in the KLIP ETF and their allocation percentages are determined by the composition of the CSI Overseas China Internet Index. As the index composition changes, KLIP's holdings will likely adjust to reflect these changes, ensuring it remains aligned with the benchmark. Benefits of tracking the CSI Overseas China Internet Index. Diversification. The index offers exposure to a diversified basket of Chinese internet companies listed outside of China. This diversification helps mitigate concentration risk associated with focusing on a few individual companies. Transparency. The index methodology and composition are publicly available, allowing investors to understand the holdings and weighting of KLIP. Benchmarking. By tracking the CSI Overseas China Internet Index, KLIP provides a clear benchmark for measuring its performance. Investors can easily compare KLIP's returns to the performance of the broader Chinese internet sector represented by the index. Important considerations. Tracking an index doesn't guarantee perfect performance. KLIP might incur tracking errors due to various factors like fees and operational costs. The CSI Overseas China Internet Index only reflects companies listed outside of mainland China. This excludes some prominent Chinese internet companies that trade on domestic exchanges. Can the methodology for selecting holdings within the KLIP ETF be easily understood? The methodology for selecting holdings within the KLIP ETF is fairly straightforward, but with some underlying complexities. Here's a breakdown of the key points. Straightforward aspects. Passive approach. KLIP follows a passive investment strategy. It doesn't involve actively selecting individual stocks based on research or analysis. Index-based selection. KLIP tracks the CSI Overseas China Internet Index. The holdings within KLIP directly mirror the composition of this index. Underneath the surface index methodology. The CSI Overseas China Internet Index has its own selection criteria for including companies. These criteria might involve factors like market capitalization, size of the company, liquidity, ease of buying and selling the stock, profitability, revenue growth. Understanding the index methodology. While KLIP itself doesn't require complex security selection, a deeper understanding of the CSI Overseas China Internet Index methodology can be beneficial. This information is typically available from the index provider, Sindex, and might involve some technical financial terms. Transparency. The holdings of KLIP and the CSI Overseas China Internet Index are usually publicly available on the issuer's website or financial data providers. This allows investors to see the exact companies included in the ETF and their weightings. Does the KLIP ETF hold a diversified basket of assets, or is it concentrated in a specific sector or industry? KLIP offers some diversification, but it also has a concentration in a specific sector and industry. Here's a breakdown of both aspects. Diversification. By underlying index, KLIP tracks the CSI Overseas China Internet Index, which inherently offers some diversification. The index includes companies from various segments of the Chinese internet sector, such as e-commerce, online shopping, social media, online gaming, internet portals, search engines, news websites, online entertainment. By holding a basket of companies from these subsectors within the broader Chinese internet industry, KLIP offers some level of diversification compared to investing in a single company. Concentration. Sector concentration. KLIP is heavily concentrated in the Chinese internet sector. This means a significant portion of its holdings are in companies that rely on the internet for their core business activities. Geographic concentration. KLIP focuses on Chinese internet companies listed outside of mainland China, primarily in Hong Kong and the United States. This excludes prominent Chinese internet companies that trade on domestic exchanges. Impact of concentration. Sector risk. The performance of KLIP will be heavily tied to the overall performance of the Chinese internet sector. If the sector experiences a downturn, KLIP is likely to suffer significant losses. Limited diversification. Compared to a broadly diversified portfolio that includes various asset classes and sectors, KLIP offers a narrower exposure. This can increase portfolio volatility. Investor considerations. Investors seeking exposure to the growth potential of the Chinese internet sector might find KLIP appealing. However, the concentration risk associated with the sector and geographic focus needs to be carefully considered. Diversifying your portfolio with other asset classes and sectors can help mitigate the risks associated with KLIP's concentration. What is the liquidity of the underlying assets held by the KLIP ETF? The liquidity of the underlying assets held by the KLIP ETF can vary depending on the specific companies within the CSI Overseas China Internet Index. Here's a breakdown of the factors influencing liquidity. Liquidity of the CSI Overseas China Internet Index. The index primarily consists of Chinese internet companies listed on stock exchanges outside mainland China, mostly Hong Kong and US. These exchanges tend to have good liquidity compared to some mainland Chinese exchanges. Factors affecting liquidity of individual holdings. Market capitalization. Generally, larger companies, with higher market capitalization, tend to have more liquid stocks. These stocks are easier to buy and sell in large quantities, without significantly impacting the price. Trading volume. The average daily trading volume of a company's stock is another indicator of liquidity. Higher trading volume suggests the stock is more actively traded, making it easier to enter and exit positions. KLIP ETF liquidity versus individual holdings. KLIP ETF itself trades on a major exchange, likely US-based. ETFs typically have their own market makers who help facilitate buying and selling, generally enhancing liquidity compared to individual stocks. However, the underlying holdings within KLIP might vary in liquidity. While the index targets companies on exchanges with good liquidity, there could be some holdings with lower trading volume or market capitalization, impacting their individual liquidity. How has the KLIP ETF performed in different market environments? KLIP, launched in January 2023, has a limited track record, making it difficult to definitively assess its performance across various market environments. However, we can analyze its strategy and underlying holdings to provide some insights into potential performance in different scenarios. Bull market. Potential upside. If the Chinese internet sector experiences a strong bull market, KLIP could benefit significantly. The holdings within the CSI Overseas China Internet Index could see significant price appreciation, leading to positive returns for KLIP investors. Capped gains. However, the covered call strategy employed by KLIP might limit the potential upside compared to a pure China Internet ETF. By selling call options, KLIP caps the potential gains if the stock price surges beyond the strike price of the options. Bear market. Downside protection. The covered call strategy can offer some downside protection in a bear market. The premiums collected from selling call options can provide a buffer against price declines within a certain range. Limited protection. The downside protection offered by covered calls is not perfect. If the stock price falls significantly, the income from call options might not fully offset the losses. Volatile market. Increased risk. Volatile markets can be challenging for KLIP. The covered call strategy can underperform if the stock price experiences rapid fluctuations. The premiums collected from options might not be enough to compensate for significant price swings in either direction. Potential for active management. KLIP's underlying holdings don't change frequently due to its passive approach. However, some ETF issuers might use more active management of the covered call strategy within volatile markets to try to optimize returns. Here are some additional points to consider. KLIP's performance will also be influenced by factors beyond the Chinese internet sector, such as global economic conditions and currency fluctuations. Backtesting the covered call strategy against historical data for the CSI Overseas China Internet Index can provide some insights into potential performance, but past performance is not always indicative of future results. What are the potential risks associated with investing in the KLIP ETF? Investing in the KLIP ETF involves several potential risks that need careful consideration. Here's a breakdown of the key risks to be aware of. Sector concentration risk. KLIP is heavily concentrated in the Chinese internet sector. The performance of KLIP is directly tied to the fortunes of this sector. If the Chinese internet sector experiences a downturn, KLIP is likely to suffer significant losses. Geographic concentration risk. KLIP focuses on Chinese internet companies listed outside of mainland China. This excludes prominent Chinese internet companies that trade on domestic exchanges. This concentration in a specific geographic region exposes investors to potential risks associated with that region, such as political instability, regulatory changes, or currency fluctuations. Covered call strategy risks. Capped gains. The covered call strategy limits potential upside compared to a pure China Internet ETF. By selling call options, KLIP caps the potential gains if the stock price surges beyond the strike price of the options. Investors forego the opportunity to fully participate in a strong bull market for the Chinese internet sector. Lower overall returns. The income generated from selling call options comes at the cost of potentially lower overall returns compared to a traditional ETF that doesn't employ this strategy. Other potential risks. Currency risk. KLIP's holdings might be denominated in currencies other than the investor's home currency. Fluctuations in exchange rates can impact the value of your investment. Emerging market risk. Chinese companies, even those listed outside of mainland China, are still subject to risks associated with emerging markets, such as political instability, less developed legal and regulatory frameworks, and potential for corporate governance issues. Counterparty risk. The success of the covered call strategy relies on the ability of the counterparty to the option contracts to fulfill their obligations. If the counterparty defaults, investors might lose some or all of the premiums collected. Liquidity risk. While KLIP itself might be liquid, some of the underlying holdings within the CSI Overseas China Internet Index could have lower liquidity. This can make it more difficult to enter or exit positions quickly, especially in volatile markets. Tracking error. KLIP might not perfectly track the performance of the CSI Overseas China Internet Index due to factors like fees and operational costs. How does the KLIP ETF's risk profile compare to other ETFs targeting similar opportunities? Here's a breakdown of how KLIP's risk profile compares to other ETFs targeting similar opportunities. Comparison with pure China Internet ETFs. Higher risk. KLIP generally carries higher risk compared to pure China Internet ETFs. This is due to the covered call strategy. Tapped upside. Pure China Internet ETFs offer the potential for uncapped growth if the underlying companies outperform. KLIP, by selling call options, limits these potential gains. Lower overall returns. The income generated from covered calls comes at the expense of potentially lower overall returns compared to a traditional China Internet ETF. Lower volatility. Potentially, the covered call strategy can offer some downside protection in a bear market. The premiums received from selling call options can act as a buffer against price declines, potentially leading to lower overall volatility compared to a pure China Internet ETF. Comparison with other covered call ETFs. Similar risk profile. Core. KLIP's core risk profile, sector concentration, currency risk, etc., might be similar to other covered call ETFs, even if they target different sectors. These core risks are inherent to the covered call strategy and exposure to emerging markets. Potential differences. Varying strategies. However, some covered call ETFs might employ more nuanced covered call strategies impacting the risk profile. Selection of underlying assets. The specific sector or asset class targeted by the covered call ETF can influence risk. For instance, a covered call ETF on a more volatile sector like biotechnology might carry higher risk compared to KLIP's focus on the Chinese internet sector. Call option parameters. The strike price and expiration date of the call options sold can affect the risk profile. KLIP doesn't offer detailed information on these aspects of its covered call strategy, making a direct comparison with other ETFs challenging. How does the liquidity of the KLIP ETF compare to other ETFs in the same category? Here's a breakdown of how the liquidity of the KLIP ETF might compare to other ETFs in the same category, China Internet or covered call ETFs. KLIP ETF liquidity. KLIP itself likely trades on a major exchange, presumably US-based. ETFs generally benefit from market makers who help facilitate buying and selling, enhancing liquidity compared to individual stocks. However, the underlying holdings within KLIP can vary in liquidity. While the CSI Overseas China Internet Index targets companies on exchanges with good liquidity, there could be holdings with lower trading volume or market capitalization. Factors affecting liquidity comparison. Underlying holdings. The liquidity of comparable ETFs depends on the specific holdings within each ETF. Here's a breakdown. China Internet ETFs. These ETFs typically hold a basket of leading Chinese internet companies. If the ETF focuses on larger, well-established companies listed on major exchanges like the Hong Kong Stock Exchange, it's likely to have good liquidity. However, some China Internet ETFs might include smaller companies or those listed on less liquid exchanges, impacting overall liquidity. Covered call ETFs. The liquidity of these ETFs depends on the underlying assets they target. An ETF employing covered calls on a highly liquid index like the S&P 500 would likely be more liquid than an ETF using the same strategy on a less liquid index or sector. Liquidity comparison strategies. Average daily trading volume, ADTV. This metric reflects the average number of shares traded daily for an ETF. A higher ADTV for KLIP compared to other ETFs suggests greater liquidity. You can find ADTV information on financial data websites or the ETF issuer's website. Bid-ask spread. This represents the difference between the highest price an investor is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for an ETF share. A tighter bid-ask spread for KLIP compared to other ETFs indicates better liquidity. How do the fees of the KLIP ETF compare to other ETFs with similar investment objectives? The KLIP ETF's expense ratio, which sits at 0.95%, can be compared to other ETFs targeting similar investment objectives in two categories: China Internet ETFs and covered call ETFs. Here's a breakdown. Comparison with China Internet ETFs. Generally higher fees. KLIP's expense ratio, 0.95%, is typically higher than most pure China Internet ETFs. Here are some examples. KWEB, CraneShares CSI China Internet ETF 0.48%. CQQQ, Invesco China Technology ETF 0.70%. FXI, Franklin Templeton China Technology ETF 0.70%. These expense ratio differences translate to a higher cost for investors holding KLIP compared to these alternatives. For example, on a $10,000 investment, the annual fee for KLIP would be $95, whereas for KWEB, it would be $48. Reasons for higher fees. Management complexity. KLIP's covered call strategy adds an additional layer of complexity compared to a simple China Internet ETF. This complexity might be reflected in a higher expense ratio to cover the costs of managing the covered call strategy. Comparison with covered call ETFs. Potentially competitive. KLIP's expense ratio, 0.95%, might be somewhat competitive with some covered call ETFs targeting different sectors. Here's an example. XYLD, SPDR S&P 500 by right ETF 0.63%. However, due to the unique combination of China Internet exposure and covered calls in KLIP, finding a perfect comparison within the covered call ETF category might be difficult. Overall fee analysis. Investors considering KLIP should be aware of its higher expense ratio compared to most pure China Internet ETFs. The additional cost of the covered call strategy needs to be weighed against the potential benefits of income generation and some downside protection. It's crucial to compare the expense ratio of KLIP not only to China Internet ETFs but also to other covered call ETFs, even if they target different sectors. Alright, so to wrap things up, KLIP offers a unique blend of China Internet exposure and income generation with some potential downside protection. It's a good option for investors seeking a balance between growth and income, but with some trade-offs. The key takeaway? KLIP comes with higher fees than pure China Internet ETFs and has capped upside due to the covered call strategy. The best choice for you depends on your goals. If you prioritize uncapped growth and are comfortable with higher risk, a China Internet ETF might be better. If income generation is your main focus, explore various covered call ETFs, comparing their risk profiles and fees. Don't forget to like and subscribe for more in-depth ETF breakdowns. And remember, diversification is key. Consider including KLIP alongside other ETFs in your portfolio to manage risk and align with your overall investment goals. Happy investing!